Well, undoubtedly, there has been no shortage of Sturm und Drang concerning the performance of the stock market in the first quarter of the year. But if we really look at it in context, the S&P 500 was down something in the neighborhood of I think it was 4.6%, so less than 5%, after 3 consecutive years increasing in excess of 20%. So I don't think that it should be much of a surprise that we're having a little bit of a pullback and also a bit of change in terms of the style of the types of stocks that have been performing. And what I'm referring to is the rotation between value and growth stocks. And of course, the single biggest value rotation that's out there in the market right now has been energy. Energy, I believe in the first quarter, it was the only sector that registered a positive return. And it was a sector that had been in the doldrums for years and years and had become very, very inexpensive. And so if you look at things from a value perspective, the fact that energy has had the very strong rebound that it has, that in and of itself would prompt that sort of growth versus value reversal. You know, the Federal Reserve clearly needs to act in response to the inflation numbers that we've seen over the past several months. There certainly was a strong hope that this inflation would turn out to be transitory and we'd be back to a more normalized inflation environment. That has yet to happen. So it's not unexpected that we would see some market response to that increase in interest rates, and also that we would see some difference in the types of companies that respond to that environment.
The market is usually always forward-looking, so they don't actually react on what's going to go on today. They're looking 6 months to 9 months ahead. And so as the Fed begins to increase the interest rates, and as inflation begins to, if you want to call it, rear its ugly head, market's looking at it saying, normally what happens is you have a first couple of months where the economy is still doing well, but eventually the odds are that the economy ends up in a recession. Throw that in there, along with that, just some uncertainty in the globe in regards to the war in Ukraine versus Russia, and you have a good recipe for the market going down quite a bit, which it did. But at the same time, as you know, a lot of times also what happens in the market is you sell first and you ask questions later, and then slowly start buying back. And you saw the same thing happening in the first quarter again. You saw initial sell-off between, let's say between January 1st till about end of February. But then March actually ended up being a rally, and that was people calming themselves down a little bit and saying, maybe it couldn't be as bad as people thought it would be. That the jury's still out on that. There's mixed opinions about how high inflation could get, how much the Fed would need to raise, and that'll play itself out in the second and third quarter.
Interest rates have rapidly risen to historic levels that are very atypical. To give you an idea, the 2-year Treasury was a little over about 25 basis points, or 0.25%. At the end of the first quarter of 2022, it is over 2.3%. That is over a 740% increase. These are substantial changes, particularly in the front end of what we call the curve, meaning the short maturity, such as the 2 years and so forth. And that reflects central banks' policy changes to get in front of inflation. And it's material, in contrast to the many challenges faced by the developed world with regards to high energy prices and food prices. Middle Eastern countries, such as those of the Gulf Cooperative Council, otherwise known as the GCC, are really in the best position in this particular environment. Not just because of the oil that they produce, which is at all-time highs, but they've also done a lot of work over the last number of years of improving their own fiscal house by altering subsidy programs, incorporating new tax schemes such as value-added taxes, and employing a lot more fiscal discipline.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting amanafunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Amana funds and a free prospectus or summary prospectus, please visit amanafunds.com or call 1-800-728-8762.